Welcome back to GMS Podcasts, and this is episode 3 of our series on steel and ship recycling prices. In the first episode, we discussed how steel prices form the base of recycling offers. In the second, we looked at why different destinations price differently. Today, we focus on timing. Ship owners often ask why an offer can change within days. The vessel is the same. The LDT is the same. The destination may be the same. Yet the number moves. Jamie, from a commercial point of view, why can a recycling offer change so quickly?
Because the market around the vessel changes quickly. Steel prices move, currencies move, buyer sentiment changes, banks become more or less supportive, freight markets move, yards reassess risk, and sometimes the practical delivery window changes. The vessel may be the same, but the recycler's economics may not be the same.
Let us start with daily steel movement. How quickly can steel prices influence recycling offers?
Very quickly, if local plate prices move down, recyclers immediately reassess their resale expectations. Even a modest move in steel can matter because the ship is a large volume transaction. A small per ton change multiplied across thousands of tons affects the economics.
And if the steel market is rising?
Then yards may become more confident, but not always immediately. They still ask whether the rise is real. Are buyers active? Are mills actually purchasing? And can the price hold until the recovered steel is sold? That is why the direction of steel is important, but liquidity and confidence decide how much of that direction is reflected in the bid.
The latest market also shows that steel does not move in one uniform direction across all recycling destinations. One market may see plate firming, another may see softness, another may hold steady. So, owners should not read one steel number as the whole story.
Exactly. The recent market is a good example of that. Bangladesh has shown firmer local plate levels. Pakistan has held firm. India has been softer. And China has also shown some weakness. That means the same global ship recycling market can produce very different local signals. For an owner, the key is not only whether steel is up or down globally. The key is whether the destination that suits the vessel has real steel demand, active buyers, and a workable resale chain.
Currency is probably the second fast moving factor. Ships are generally bought in US dollars, while recovered steel is sold locally. That creates a very real exposure for the recycler.
Yes. If the local currency weakens, the recycler's dollar buying power reduces. That can force bids down quickly, even if domestic steel prices appear stable. A stable or strengthening local currency can support bids. A weakening currency can reduce bids, even if the domestic steel market has not visibly collapsed.
In recent weeks, lower oil helped some South Asian currencies, but the stronger US dollar also became a counterforce. So, from an owner's point of view, a local steel price can look unchanged, but the dollar offer can still move because the currency picture has changed.
Correct. That is why recycling prices must always be read in both steel and currency terms. Oil, dollar strength, local inflation, reserves, capital flows, and central bank policy all matter. A recycler is not only buying steel, he is taking a currency view as well.
Sentiment is harder to measure, but in our market it matters enormously. How does sentiment affect bids?
Sentiment affects risk appetite. If mills are buying, traders are active, banks are cooperative, and yards believe prices will hold, recyclers bid more confidently. But if downstream buyers pause, inventories build, or rumors of price weakness spread, yards become defensive. Sometimes the published steel price has not moved much yet, but sentiment has already changed.
So the bid can move before the published steel price fully reflects the change.
Exactly. Recyclers are not only reacting to published prices, they are reacting to what they hear from mills, traders, bankers, and other yards. In recycling, the market often moves first in sentiment, then in numbers.
The latest market is also a reminder that sentiment can change when a major disruption ends. When war risk premiums unwind, when freight normalizes, and when vessel traffic starts moving more freely again, the recycling equation can change quite quickly.
That is right. During a disruption, owners may keep older ships trading because freight improves or routing uncertainty supports earnings. But when that disruption eases, the same owners may reassess. Bunker cost pressure can reduce. Freight can come off its peak. The premium that kept certain older vessels trading can unwind. That is when deferred recycling candidates can start to reappear. But even then, it does not mean the vessels reach the beach immediately. The yards still need the right timing, the right tide, the right approvals, the right finance, and the right seasonal window.
Let us discuss financing. A yard may like a vessel, but without finance, the bid is not meaningful.
That is right. Ship recycling requires significant liquidity. Buyers need LCs, credit lines, bank support, and working capital. If financing tightens, bids reduce. If LC processing improves, the market becomes more active. This is especially important in South Asia. Strong steel demand without bank support cannot produce strong execution.
So ship owners should not look only at who is offering the highest level. They should ask whether the offer is finance-backed and executable.
Exactly. The quality of the bid matters. A slightly lower bid from a buyer who can perform may be better than a higher theoretical number from a buyer who cannot open the LC or complete the transaction.
This is an area I want to bring into the steel discussion. Steel prices may support recycling levels, but if freight is strong, owners may not sell. We have seen this, especially in dry bulk.
Yes, freight is critical. When earnings are strong, the opportunity cost of recycling increases. An older vessel that might have been a recycling candidate can continue trading if daily earnings justify it. That means the recycling market can have demand, finance, and price support, but still no supply.
And when freight starts normalizing, the owner's calculation changes again.
Exactly. Steel drives the bid, freight drives the owner's alternative. If the trading market is paying well, owners often wait. If freight comes off, the case for continued trading becomes weaker, particularly for older vessels with dry dock, survey, or capex decisions ahead. That is why recyclers and owners sometimes see the same market very differently. The recycler is looking at steel risk. The owner is looking at trading optionality.
This may be the most important part of the episode. A recycler buys the ship before selling the steel. This is the point owners sometimes underestimate. How do yards price that gap when the steel market is moving?
When a recycler buys a vessel, he pays based on today's market expectations. But he may only recover and sell the steel gradually after delivery, beaching, and cutting. During that period, steel prices can fall. Currency can weaken, demand can slow, financing costs can rise, regulations and port conditions can also change, so the recycler builds a risk buffer into the bid. When markets are stable, that buffer may be smaller. When markets are volatile, the buffer increases.
That explains why offers can fall even when owners feel the market still looks firm.
Yes. Recyclers price risk before the loss appears. They cannot wait until the market falls to protect themselves.
The market also reminds us how important seasonality is. A market can improve on paper, but the real window to deliver may already have narrowed. That could be because of monsoon, holidays, tides, freight, or owner timing.
Exactly. Timing in recycling is not theoretical. A good price in the wrong week may not be executable. The market can improve on paper, but if holidays, tides, monsoon, yard schedules, or delivery windows interfere, the opportunity may already have passed. There are periods when demand remains and financing is workable, but the ships still do not arrive within the practical window.
That is very relevant now. There can be a queue of potential candidates forming offshore, but the yards may still have to wait for the season and the beaching window.
Correct. A reopening supply pipeline is important, but supply needs to meet a practical recycling window. If the monsoon is active, if holidays slow the market, or if beaching tides are limited, even a good commercial setup can take time to convert into deliveries. That is why an owner should not only ask, is the price available? The owner should ask, can this transaction be executed in the available window?
So the owner who waits for a better number may also be taking timing risk.
Exactly. Waiting can work, but it is not free. The owner is exposed to steel risk, currency risk, freight risk, regulatory risk, and seasonal risk.
Let us make this practical. Before deciding whether to recycle now or wait, what should ship owners watch?
I would watch 8 indicators. First, steel price direction. Is the local plate market rising, flat, or weakening? Second, real buyer activity. Are mills and traders actually buying or only quoting? Third, currency stability. Is the local currency stable against the dollar? Fourth, financing availability. Are buyers able to open LCs and perform? Fifth, freight earnings. Is the vessel earning enough to justify continued trading? Sixth, regional price spread. Is one destination clearly ahead, or are markets converging? Seventh, market disruption. Are war risk premiums, routing issues, bunker costs, or freight distortions changing the owner's alternative? Eighth, timing. Are holidays, tides, monsoon, delivery windows, or regulatory deadlines affecting execution?
And I would add one owner's side factor, the cost of waiting. If the vessel has a coming dry dock, class renewal, ballast water issue, special survey, or weak employment prospects, then waiting for a slightly higher steel price may not be worth the risk.
Exactly. Trying to capture the absolute top is difficult. Owners should think in terms of risk-adjusted timing, not just the highest possible price.
Let us address that directly. Owners naturally want the best price. But what is the danger in trying to time the peak?
The danger is that the peak is usually clear only after it has passed. An owner may wait for a little more. Sometimes that works. But if steel turns, currency weakens, finance tightens, freight changes, or the beaching window closes, the market can move against them quickly. For a ship owner, the real question is not only can I get more, it is what risk am I taking to get more?
That is the right framing. In recycling, a firm and executable offer at a strong level may be better than a theoretical higher level that never performs.
Exactly. Execution is part of the price.
The main takeaway from episode 3 is that ship recycling offers can move quickly because steel, currency, sentiment, finance, freight, disruption risk, and timing risk all move quickly. For ship owners, the right approach is not to watch only the headline price. Watch the direction of steel, the depth of demand, the stability of currency, the strength of financing, the level of freight, the regional price spread, the market disruption picture, and the timing of execution. Across this series, the message has been consistent. Steel drives the recycling bid, but the final outcome depends on the whole chain. The market, the vessel, the buyer, the finance, the destination, and the timing. Jamie, thank you for joining with us for this series.
Thank you, Naeem.
And thanks to everyone listening to GMS Podcasts. This has been our focused series on steel and ship recycling prices. Stay connected with GMS for more market insight and practical recycling intelligence.